In this video, I'm going to show you a powerful three-step price action strategy you can use on stocks, forex, crypto, whatever. And by the end of this video, you're going to have a simple, repeatable way to understand what the market's really doing on the 1 hour chart. You're going to stop trading based on what lagging indicators are telling you to do, and you're going to start trading based on what you can see with your own two eyes. Now, the biggest problem for most traders isn't that they have too little information, it's that they have way too much. They're taught to depend on complex indicators that are, by definition, always late. So they react to what's already happened. The fix is to learn how to read price action directly, because price is the only source of truth. And this strategy is built entirely on that idea. So we're going to focus on the 1 hour time frame, and for a good reason. The 1 hour chart is a fantastic middle ground. It cuts out the noise that you're going to see on like a 5-minute chart, but it still gives you plenty of high quality trading opportunities every week, unlike the daily chart, which can be too slow for most active traders. And the framework, it's universal. That means it works on anything, whether you're trading Apple stock, the Euro US dollar, or Bitcoin. The underlying psychology of markets, this constant tug of war between fear and greed, it's the same everywhere, and it's all visible in the price. And the strategy has 3 logical steps. First, we figure out the market's current direction. Second, we find a high probability zone to trade from. Third, we wait for a specific price signal to give us the green light. So let's get into the first one, and the most foundational step is identify the market structure. And before you put a single dollar on the line, you need to ask a simple question. Who's in charge here? Is it the buyers? Is it the sellers? Market structure is going to give you the answer. It's the blueprint of the market. Everything else is built on top of it. And a market can only be in one of 3 states, an uptrend, a downtrend, or a range. Uptrend is a series of higher highs and higher lows, and this tells us that the buyers have the upper hand, and we probably want to be looking for buying. Downtrend is the exact opposite, a series of lower highs and lower lows. And this is a sign that sellers are in control. And our focus should be on finding opportunities to sell. In a range or a consolidation, price is just bouncing between a clear ceiling and a floor. It's going nowhere. Here, the classic play is to buy near the bottom, which is support, sell near the top, which is resistance, or, I prefer, just sit on your hands and wait for a real trend to kick in. And getting this right, it's non-negotiable. The job here is to find the path of least resistance and ride the market's momentum. So, pull up your chart. Look at the recent swing points, the peaks, the valleys. Are they generally climbing higher or going lower? Is it stuck in a channel? Answer that one question immediately puts the odds in your favor. Number 2, got to mark our levels so we know which way we want to go. Now we need to figure out where we want to trade. We don't just jump in randomly. We wait for the price to hit a level, a zone where the market has reacted before. We can call these support and resistance levels. Support is just a price level, or more accurately, it's a zone where buyers have historically stepped in, preventing the price from going down. Think of it as the floor. Resistance is the opposite. It's a price ceiling where sellers tend to show up in force and push the price back down. And finding them is pretty straightforward. Just look for the most obvious turning points on your chart, the major swing highs and the swing lows, and draw some lines. The strongest levels are the ones that have been tested over and over again. And a level that once acted as a ceiling, resistance, and after being broken, turns into a floor, support. And that is an especially powerful area to watch. And don't think of these as perfectly thin lines, but these are zones, like a big paintbrush. Price will often poke through a level for a moment before reversing. And by marking a small zone around your key points, you give yourself a more realistic area of interest. These levels are where market decisions tend to be made. It reflects the collective psychology of traders. And by marking them on your chart, we're creating a map of where we're going to look to engage. And now we wait for the entry signal. We've got our trend direction. We know our location. Now for the final piece, the trigger. And this is the specific price action signal that tells us, okay, it's time to go. And we're going to focus on 2 classic high probability entry patterns. The first one is the breakout and retest. And this is probably the most reliable pattern you're going to find. A breakout happens when price pushes through a key level decisively, not a poke. But if you just chase that initial surge, well, it's a great way to get caught in a fake out. The better move is wait for the retest. So after breaking through resistance, the price will often pull back to retest that same level in the area. And that should now act as new support. And that retest is our entry point. We wait for a confirmation candle like a bullish pin bar, an engulfing candle, an inside bar, any candle that shows buyer's strength. Because a breakout of an inside bar to the upside is a breakout of consolidation. And we want all of this to form near the retested level before we buy. It's just the market's way of telling us it's accepted the new price and it's ready to continue. We can also look for price to break the level with strength and then start to base, which means go sideways. Placing a bet on the breakout of this pattern is also viable. But keep in mind that it is perfectly natural for price to break back under a former resistance line. It doesn't invalidate that level. You just need to see price being rejected from that area. The second pattern is just a reversal at a key level. And this happens, price moves up to a major resistance level in a downtrend, for example, or down to major support in an uptrend and stops. We're not looking for a breakout. We want that level to hold. And our signal comes from a reversal candlestick pattern. Again, two most common ones are the pin bar, the engulfing bar, but again, any candle that shows strength is a good one. A bullish pin bar at support has a long tail or a wick or a shadow, whatever you want to call it, pointing down. It shows that the sellers tried to force that price lower, but were aggressively beaten back by the buyers. And a bullish engulfing candle, that happens when a big green candle swallows the previous red candle. That signals a huge shift in momentum. And these patterns, these are our evidence that buyers are stepping in with conviction at our level. That's our green light. And if this step-by-step approach is making some things click, it's making sense, do me a favor, hit that like button. It tells me that you're finding this useful and we should make more videos just like this one. All right, let's go to an example. We're going to put all the pieces together in a real world example. So let's say we're looking at this stock. It's a 1 hour chart. Step one is the market structure. We just zoom out a bit to see the bigger picture. We clearly see that price is making a series of higher highs and higher lows. The structure is bullish, so we only want to buy. Second one are key levels. We look for major turning points. We see a very clear horizontal resistance zone where prices got rejected 3 times. We draw a small zone around these levels. That is our hunting ground. Now the entry signal. We wait for price to either break to the downside, in which we just move on from this chart, or it breaks out. We look for the retest. So on Tuesday, price gaps above. And on the Thursday, price comes back to the breakout price, the area. We have one reversal green candle show up, and I do like to add half of the ATR to the close of the candle for an entry price. This doesn't trigger, we get a red candle. The next time we see a green candle, it takes out the low of the preceding candle and then closes above 50% of the red candle. That's a bullish move. The entry is set at half the ATR plus the close, so $19.52. The stop is below the low, and I like to use 0.25% of the ATR below the low, so $18.90. And for our take profit, we look to the left of the chart to find the next area of resistance. We want to make sure our potential reward is at least 1.25 of the risk. Right, just keep it simple at first. Eventually, you're going to learn other profit-taking techniques as you get more experience. From there, trust the plan and let the market do its thing. This strategy is effective, but no strategy on earth wins all the time. So the secret to staying in this game is rock-solid risk management. And a golden rule is to never risk more than 1 to 2% of your entire trading account on a single trade. That's the golden rule. Sometimes I risk more depending on the setup. But this ensures that a string of losses is just a small little setback, and patience is vital. Successful trading is mostly just a waiting game. It's not about constant action. It's about patiently waiting for that A+ setup to come to you. And you need to have the discipline to wait for price to hit your levels and for your specific entry signal to show up. If a setup does not tick all those boxes, you do nothing. You walk away, find something else. The market is going to be here tomorrow, and you can find another opportunity. So quick recap. First, identify the market structure. Uptrend, downtrend, range. Go with the flow. Second, mark your key levels or your zones. Find the obvious zones where the market has turned before. These are your areas of interest. Third, wait for your entry signal. Be patient and wait for a high probability trigger like a clean breakout and retest or a powerful reversal candle like a pin bar or engulfing bar. And the beauty of this strategy, it's simple, it's logical, and it takes you away from gambling and guessing and towards a clear and repeatable process. And the only way to build real and unshakable confidence is just prove it to yourself. Open up your charts, any market you like, it doesn't matter. Scroll back in time. Apply these 3 steps. See for yourself how often these precede major moves. Practice it, test it, find some nuances that I can't teach you that you have to find for yourself and make it your own.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.